Royal Dutch Shell Company is a multinational group of oil and gas subsidiaries that is headquartered in the Netherlands. They use advanced technology and take an innovative approach to build a sustainable energy future. Their presence can be felt worldwide. The purpose of this video is to explore a detailed outline of the financial status of Royal Dutch Shell and to provide an in-depth analysis that would satisfy any investor or economist interested in the company. To fully understand Shell's performance and financial impact on the market, we must dedicate time to explore its history and evolution. In 1833, Marcus Samuel, a London antique merchant, began trading shells obtained from the Far East. His two sons, Marcus Samuel Jr. and Samuel, expanded his business into trading oil using steamers for the very first time. In 1892, they passed an oil tanker through the Suez Canal, carrying 4,000 tons of Russian kerosene towards Singapore. The Royal Dutch Company had formed in 1890 and began expanding into Asia. In 1907, Shell and Royal Dutch merged in order to protect their business from stiff competition and larger companies such as Standard Oil. The tough competition Shell and Royal Dutch experienced over 100 years ago hasn't let up much. Giant oil companies stretching across the globe compete for their share of the market. ExxonMobil, one of the most fierce competitors, is a US-based provider. They are the largest publicly traded oil and gas company, and even their previous CEO, Rex Tillerson, has become the US Secretary of Defense. Exxon has one of the largest revenues in the world. BP is the third largest publicly traded oil company and has the largest oil and gas producer in the US and is a top refiner. Shell's annual report has been centered around its recent acquisition of the BG Group. The overarching goal of buying the BG Group was to create value for its shareholders. Revenue for the year was $233 billion in 2016 compared to $264 billion in 2015. $15 billion was distributed to shareholders in dividends. The impact of the BG Group was offset by steps taken to reduce expenses. More than 300 million more barrels were produced in 2016 compared to 2015. Analyst recommendations have favored the Shell Corporation, most overwhelmingly rated as a buy. Markets FT labels majority buy, as does Street Insider and MarketWatch. Nasdaq has taken a strong buy position. Royal Dutch Shell has attracted a lot of attention in the media because of its massive impact in the marketplace. Recently, the Wall Street Journal has reported a deal, a $1 billion sell-off of gas assets in Western Canada. The company has elected to go with a divestment strategy in that region. The New York Times has discovered a group of oil workers in the North Sea gearing up for a strike, saying that industry-wide cuts have been too deep. The labor action by unions representing about 400 maintenance workers on 7 oil production platforms operated by Royal Dutch Shell is part of the broad struggle to find an equilibrium. Barron reports good signs coming from capital investment. That's why investors cheered last month's announcement of a growth plan that looks more like a shrink plan. Shell says capital investment will total $25 billion to $30 billion from 2017 through 2020. Shell says it expects the BG deal to yield $4.5 billion in yearly cuts and reduced exploration by 2018 up to an initial forecast of $3.5 billion. Shell has released multiple press releases during this last month. Royal Dutch Shell, through its affiliates, have reached an agreement with Assala Energy Holdings Limited, a portfolio group of the Koryala Group, to sell 100% of its Gabon onshore interests for $587 million. The sale and purchase agreement is subject to certain conditions in which include various approvals. Closing is expected in mid-2017. As previously announced, Simon Henry stepped down as Chief Financial Officer and as a Director of Royal Dutch Shell with effect from March 9, 2017. He will repatriate to his base country, the United Kingdom, and become an employee of Shell International Limited with effect from April 1, 2017. Mr. Henry remains available to the incoming Chief Financial Officer and to the Shell Board to assist with transition and will leave employment with the Shell Group on June 30, 2017. Royal Dutch Shell has an attractive 7% dividend yield, more than double what you'd buy from ExxonMobil stock. With the shares near a 5-year low, Royal Dutch is looking attractive to investors. Royal Dutch Shell is currently trading for $52.85. Competitors BP and ExxonMobil is trading for $35.92 and $81.84 respectively. Insider trading from management hasn't been active lately, but Shell is currently under trial for the last 12 years on claims of 700 investors' shares were undervalued during a 1996 takeover by Fletcher Challenge Energy. The group is seeking tens of millions of dollars in compensation from Shell, which inherited the assets and obligations of Fletcher Challenge Energy following a 2001 takeover, based on claims price-sensitive material stemming from the presentation was withheld. Current Chief Executive Officer and Director Mr. Ben Valberden has a reported compensation of €3.9 million, while his number two, Simon Henry, has a compensation of €2.4 million. The PE ratio for Shell is 48.33. The average for the S&P is 15, so you can tell it's not cheap on the market. And investors expect a rise, which makes sense since it's at a 5-year low right now. If you look at the BP's PE ratio, it's 457. You can infer that that stock is overpriced. Dividend yields for Royal Dutch Shell is 7.2%. This is high for the industry standard. Investors prefer energy stocks for this reason exactly. BP has even surpassed Shell. Exxon, however, falls behind both. The organization holds a beta of 0.988, which implies as returns on the market increase, Royal Dutch returns are expected to increase on the market as well. Return on equity is a measurement of profitability. Most analysts believe a return on equity under 10% is unsatisfactory. Each of these is well below that figure. Capital structure is how a firm finances its overall operation and growth. The finances retrieved from the 3,600,000 barrels per period funds its operation. The earnings per share for Royal Dutch Shell is impressive with the .920 in 2016 in the first quarter. This year started slow, but it forecast to bounce back. Exxon is forecast to have a great 2017. BP's 2017 book value per share of Royal Dutch Shell falls between Exxon and BP. Exxon has the most outstanding shares, so it's not surprising. Other than the merger of the Royal Dutch Company and the Shell Company, the recent acquisition of the BG Group into the oil giant has defined the financial status of recent months for the company. Shell agreed to buy the BG Group for €47 billion in cash and shares, the 14th largest ever corporate takeover. The combined company can exploit rising demand for natural gas and relatively plentiful and clean burning fuel. The BG shareholders would own roughly 19% of the merged company. Foreign exchange gains of $3 million in 2016 and losses of $731 million in 2015 and $263 million in 2014 were mainly due to the impact of changes in exchange rates on currency loans and loan balances in the operating units. In 2016, foreign exchange gains from the strengthening of the Brazilian real against the dollar were offset by losses due to the strengthening of the dollar against most other currencies to which Shell has exposure from loans and cash balances. They operate in more than 70 countries and have differing degrees of political, legal, and fiscal stability. This exposes them to a wide range of political developments that could result in changes to contractual terms, laws, and regulations. In addition, they have joint arrangements and associates face risk of litigation and disputes worldwide. They are exposed to fluctuating prices of crude oil, natural gas, oil products, and chemicals. Operations expose them to social instability, civil unrest, terrorism, piracy, acts of war, and risk of pandemic diseases that could have material adverse effect on their business, as seen in recent years in Nigeria, North Africa, and the Middle East. My personal analysis of Royal Dutch Shell's past performance is one of success that depends on external factors. This industry heavily relies on energy costs being high. As prices across the globe decrease, Shell loses the ability to keep wages up and leads to what happened in the North Sea. Workers get upset and strike. The acquisition of the BG Group has not been met with unanimous support. But as energy prices rise, the additional assets acquired by BG will be extremely helpful. Its Brazilian untapped oil fields look very promising. I would buy RDSA stock Royal Dutch Shell boasts a 7.2 dividend yield. The acquisition of BG is a promising sign for a bright future. Some experts have forecasted they will reduce their dividends, but the company management have alluded to keeping them high. It would be a great stock to hold and collect as dividends and income.